Hey Miles, hey Tom, thank you so much for making yourself available. You have both been
Thank
on
you.
my channel before. Tom, you've been on my channel not enough times, and Miles, you've been on my channel not enough times, right? And I thought it'd be a good idea to put you both together. I'll have all the
Sure.
links where people can find both of you on X and your channels and stuff like that in the description below.
Mhm.
So thank you guys. And I start with a warning, which is I may not understand what is going on in this conversation, right? Because
Right.
we're gonna talk about the Genius Act and possibly the Clarity Act and what's happening with stablecoins and the Federal Reserve. Because I think you both got slightly different takes on it.
Hmm.
You're both like me, not sold into eating insects and CBDCs and digital IDs and stuff, right?
Yeah, that would be putting it mildly.
At least those are your public positions.
But yeah, public position.
Privately, you might relish chocolate-coated crickets, but hey, that's up to you, right? Oh, okay. So,
More like chocolate covered ribeye, but all right, never
chocolate
mind.
covered ribeye, that's something.
No, it's not. That wouldn't be good either.
It wouldn't be.
Separately,
Okay, ribeye,
consecutively, not concurrently. Yes.
right, ribeye and then chocolate. Okay,
Yeah.
you go. Can you go for that as well, Miles?
Yeah, I'm good for that.
All
Yeah.
right, good. Okay. So, look, does one of you want to start? Miles, I'm going to ask you to start. If you want to say what is like just some basic background with the Genius Act and the Clarity Act and what's happening there. Just an overview for people.
Yeah, so if I just concentrate on stablecoins just more generally there, I
But if you
think
could say
it's
how they're going to be created, what Trump is planning with the Genius Act as well, so people have some sort of basic grounding.
sure. So I think the most important thing there is that you distinguish between the two different types of stablecoin: the regulated, such as USDC, Wells Fargo, PayPal, whoever it is that becomes the issuer of those coins. Under the actual Genius Act, as opposed to USDT and Tether, which is your unregulated stablecoin. So that's offshore. Now, my thinking really has really sort of evolved on stablecoins and the whole sort of background to this. So originally, I was thinking, right, okay, so they're looking for new absorption for government debt, which I still believe is the case, absolutely, internationally, and I think Latin America is a key target. Certain African states are also targets, such as Nigeria and then Turkey as well. So, quite economically significant areas. So I think, there is a need to actually encourage more US dollar concentration ultimately in these countries, which could eventually sort of dollarize these nations, because it's going to mean that if you're facing like 20% inflation in these countries, you're going to want to hold dollars as opposed to local currency. So it's going to have a direct impact on banking deposits there. Now, that's going to actually reduce the sovereignty of those nation states, because their monetary policy isn't going to function as it did, because they're more beholden to the US, of course. So I find that very, very interesting. And of course, this is happening in the background of quantitative tightening, where central banks globally, the major central banks, have been restoring the health of their balance sheet, getting rid of government debt. But of course, that debt isn't paid off; it's simply redistributed. So, what's almost taking place there is a systemic redistribution of sovereign debt risk as well, which I find quite interesting. And that, for the first time ever, is happening at the global retail level. Via stablecoin and stablecoin growth. So I find that all fascinating. And one other area that I hadn't previously really given as much attention as I think it really deserves is how it also helps support the US banking system as well. And of course, with the Genius regulated stablecoins, which US citizens will only be able to access as opposed to the USDT, then because you're not allowed to get a yield with the primary issuer, it means that everyday citizens aren't suddenly going to withdraw their bank deposits and put them into stablecoins. So I find that very interesting, that dynamic, because of the yield structure and the incentive structure that seems to be in place there. And what they're also, of course, doing there is making sure that they're a one-for-one backing via short-term US Treasury debt.
Right.
And so that ensures that they're not doing what Tether are doing, using Bitcoin, using gold, whatever else. And obviously, within all of this, you are also building the programmability and surveillance kind of architecture as well behind all of this. So that's probably something we'll come on to a little later. But there's all sorts of dynamics there. So it's almost like financial colonialism, as well as at the same time protecting the US banking system, it seems to me.
Okay.
Well, yeah, it's a mixture of those things, and I'm not going to. But at the same time, what it's really doing, and this is, I think, the part that a lot of people are missing, and I don't consider any country that has an operating central bank that issues currencies based on issuing debt and that are funded through taxation. So that's a fundamental abrogation of individual sovereignty of the taxpayer and of the consumer through a central bank, through a monopolistic central bank. If you look at it, if you look at it from the opposite perspective, it's that we're going to, at least in the United States, we're going to bypass the Federal Reserve directly. We're going to bypass the Bank of Turkey. We're going to bypass whoever and get those stablecoins into the hands of the banks. Let's look at it from the American perspective, and everything else is kind of goes from there. You're trying what Trump is clearly trying to do, and what the Genius Act is designed to do, is to create a digital form of greenback, which the British killed Lincoln for, by the way. Like, that's the main. Well, aside from winning the Civil War, the greenback was a decoupling of the money from the state architect and the state bank architecture at that time, and any potential for a central bank, because it's a private form of money ultimately. And so in this case, what the stablecoins are doing is to bypass the Federal Reserve in the transmission of monetary policy, right? The banks want the consumer wants to borrow money from the bank. The bank wants to lend the money to the consumer. How does the bank do that? Without having to go to the Federal Reserve, they got to borrow from the Federal Reserve at X and then lend at X plus 3, for example. Now you're just going to lend at whatever the market will bear, borrowing the money from the Treasury at X plus 3 directly, and not going through the Federal Reserve. More appropriately, the rate on those T-bills will be set in the repo market, not by the Federal Reserve and Fed funds rate. So it's a way of getting around Fed funds, which has already effectively been neutralized by the implementation of SOFR, right? By removing SOFR, it all but effectively destroyed the Fed funds rate as a tool of monetary policy. And by the way, that was put in effect by the Federal Reserve under Jerome Powell. So, and it's a means by which to do the end run around that, and then fund the government through different means, meaning now they can fund the government however they want, i.e. through tariffs or through just the natural lending process of the demand for capital. And the rate that we're going to pay is going to be based on a market rate. And that market rate is then obviously going to be underscored by the repo markets and the demand for money. You're actually removing leverage from the system by doing this. And this is, I think, the important argument here. Now, banks themselves are only going to lend in a fractional reserve way based on what their depositors and their lenders are going to stand. We're going to get away from the runaway leverage that has existed for the last 50 or 60 years with the rise of the Eurodollar system. So it's a different way of re-dollarizing the world, but at the same time offering the rest of the world a means by which to tell all the other countries, get your houses in order. Because if US dollar stablecoins are out competing Turkish lira, that's on the Turkish government, for example, who have been a terrible steward of their currency. Now, for any number of different reasons. And we can go into the geopolitical issues surrounding just Turkey alone, for example. Which would take up the entire podcast. Like, just to discuss Erdogan and his relationships and everything else would take up an hour. But we're just using Turkey as a perfect example of a country that's gone through hyperinflation over the last 7 to 9 years, right? Since about 2018, really since 2012. Honestly, they've been going. Remember, the Turkish lira used to trade at about 1.8 versus the dollar. Now it's trading in the 30s. It's literally gone through hyperinflation over the last 15 years. And it's not been a slow motion hyperinflation either. It's been and it's been steady. Now, part of that is because Turkey has, played games with, geopolitically, and we've attacked it, or various geopolitical entities have attacked it in order to get it to play ball. But the stablecoin, as it exists now, is to say, look, this is a model. This is what we're going to do. What are you going to do? Right? I mean, it's not like they couldn't issue Turkish lira or stablecoins if they didn't want to. They can. But who trusts them? That's the key question. The United States has the ability to put something like this in play because the United States has never defaulted on its debt openly. Have we inflated the currency and do you want to call that default? That's fine. But other countries have just literally said, you know what? We're canceling the bonds. Like, we've never canceled a bond. I mean, this is one of our superpowers in the world market today. And so this is why they can get away with doing what they're attempting to do. So the regulated stablecoins are meant as a means by which, within the United States, for us to pay a rate to get access to dollars that's less than the rest of the world, who's definitely going to pay a market access charge to get access to dollars. Offshore stablecoins are going to trade at a premium. In effect, an offshore dollar are going to trade at a discount, not a premium, but at a discount, and to onshore dollars, which are going to trade, with greater purchasing power. And it's very similar to what the Chinese have done. And then, as far as the point about surveillance, like, they already have it. Like, they already see everything we do anyway. Like, it doesn't matter.
Tom, we'll come to the surveillance aspect. Miles, do you want to respond to what Thomas said about the structure of it domestically and how they?
Yeah, well, I think there's actually a good deal that we agree upon there, particularly about the dollarization element and what is effectively neo-financial colonialism. I think
that's the part where I disagree. I don't think this is new colonialism. What I think is this is the end of financial colonialism through the use of tax and spend authority given through a central bank, and the central banks are the mechanism of colonialism. This is a way of actually getting rid of that, because if you look at the way Trump is setting up the trade deals, what he's actually trying to do is export the American system, which is not to use debt and debt financing and taxation as the means by which to extend the markets, but to actually reverse that process and make these countries trade partners in a real sense by doing real investment in their countries. So, for example, like the trade deal with Australia, for example, was exactly that.
Okay, so Miles, how is it neo-financial colonialism?
Well, it's essentially using a brand new form of weaponization of the currency to ensure that you have these countries now dollarizing in effect, because for whatever reason, these central banks have decided to actually conduct reckless monetary policies in these countries, and consequently, they've lost, as Tom was saying about the respectability of the United States, they've lost their credibility. Yes. Hence, their currency is depreciating quite rapidly, and thus it's going to incentivize the population to actually disembark that currency. And now, for the first time ever, they've got access via their mobile phones to becoming a proxy holder of US treasuries, basically.
Yes, that I agree with.
And that is absolutely profound, because it means the sovereignty of the state is, from in an economic sense, is largely removed.
Now, in that regard, right? And just so you know, I'm just on the edge of understanding here, okay? Mm-hmm. But I'm sure there are viewers who understand better than me, and this is how I'm going to learn, by going on the edge. Is it analogous to how the euro and the CFA, the colonial franc, undermines the sovereignty of former French colonies and also the eurozone? Is that what you're?
Well, I think there's differences, because of course, like the Triffin dilemma, if you consider that, which is ultimately using a kind of reserve currency status as a kind of form of abuse on your colonial powers, that was really pioneered by Rome, 2,000 years ago. So what they were doing was ensuring that they were getting their tax paid in Roman coins, of course. So obviously this is a new digital format, and they're not paying their taxes in US dollars, But of course, it is incentivizing the populace to actually start trading in dollars. Now, I saw on X today that someone was identifying prices in a supermarket in Bolivia priced in USDT as a prime example. And that is obviously incentivizing the ownership and the holding of tether stablecoins. But I think just going back to the domestic impacts as well, and what I was saying regarding how it can help actually protect and reinforce the US banking system, that obviously just ensures that the Fed has control as well in terms of liquidity within the system. So if you're marginalizing domestic holding of
You're in the UK, actually anywhere, get a VPN if you want to be able to access all sorts of perspectives.
US stable coins, because they're regulated, because you don't generate a yield on them in the same way, then you are protecting your deposit base, which then does mean that the Fed still controls the deposit base via the banking system as well.
Sure. No, I'm not going to argue that point. The Fed, the way I've decided to look at the model here. But again, I want to take exception to the idea of colonialism, because colonialism implies using a cheap currency in order to extract real wealth. That's the reason why all the European powers went around the world. They went around the world to here's nothing, we want all your something. Right? We're going to give you nothing, which is the shitty currency, and we're going to pay you nothing, and we're going to extract all your somethings, your cobalt, your gold, your silver, your diamonds, your whatever. That's the old model, and that model, because they control the pricing of the currency that they are issuing through the central bank, they can ensure that the VIG rolls up to them.
But right? that's where I'd say that it's a neo form of that, where I
don't necessarily see that, because if those dollars are trading at par around the world. The yield that's being generated against those stable coins, and there's necessarily no yield being what the yield is being paid to the bank for taking on the risk of the term deposit, the term on the loans that they're putting out. Remember, it's 363 banking. At a certain point, the bank has to be paid to take on the risk of making the loan. Otherwise, there's no stable coins being issued domestically, right? So under the current model, you go to the bank and want a car loan. The bank goes to the Fed and says, says this person wants $20,000 or $30,000 to go buy a car. The Fed loans that to them at Fed funds rate. The bank then loans that money to you at Fed funds plus 3. Well, we cut out the middleman on this, and essentially the bank instantiates the loan with you because you're a credit risk, turns around and buys the stablecoin, issues stable coins and backs them with treasuries at 3%. They get their 3%, but you're not paying the extra 3 necessarily. Right?
The Fed funds rate is not being paid.
You're not paying 3. You're not paying 3%. Now it's a much more negotiated settlement, right? And that's going to be based on whatever the bank is, whatever the leverage ratio of the bank is. So, and what they're willing to take on. So, this is a mechanism by which to shift to make that a market-driven event, as opposed to having it be determined directly by the Federal Reserve and or the central bank, which can then use the business cycle to their advantage. That's the power of the central bank. It's not the individual moment, right? It's not the individual loan. It's the, hey, we're going to lower interest rates and create and exacerbate the boom that's already happening by making it worse. And then we're going to cut off the flow of funds early in order to, by raising interest rates again, and then start the process and then launder you out. And that's where they're making all their money. Like, think of it this way. And I thought about this a lot in terms of like the 30-year mortgage here in the United States. Why the 30-year mortgage, government-sponsored 30-year mortgage is actually a very interesting problem, or interesting invention. In most of the rest of the world, everybody's on a 5-year balloon, basically. You may be on a 30-year amortization, but you're on a 5-year balloon, meaning your rate's going to change every 5 years at best. Why? Because the bank doesn't want to take on term risk beyond 5 years. So what does the central bank do? The central bank's on about a 4-year cycle of moving the interest rates up and down based on where they see the bulge in the refinancing is going to occur, to ensure that they refinance at the most mortgages at the highest rate when the balloons come due, and then reverse the trend to suck everybody into new five-year balloons on the next side. But they're constantly playing that game. The United States is literally trying to, I think, remake the global financial system away from this system. There's got to be yield. There's got to be the banks have to get paid for their term risk. The question is going to be how that gets handled. And if you have a country that has destroyed its people through inflation, bad central bank policy, and everything else, the United States is happily willing to come in and go, look, we'll give you a stable currency for you to play around with. This is what Tether is doing, right? And then that's in a fundamentally different market. Like Tether is an international and offshore dollar system in effect, but it still has to, and it's still ultimately, it's unregulated, but it's still regulated. Like Tether still operates under the auspice of whatever the United
States. It's effectively in partnership with the US, really, isn't it?
It has to be, yeah. It was from the minute that they settled with Letitia James in Southern District of New York for a slap on the wrist, right? So, I mean, this is the worry that everybody has at this point is that we're going to move to digital assets that are going to be financially tracked all over the world, right? I'm not arguing that that's not a worry, that's not a risk. It's obviously a risk. The then big question is, what role does cash play in the future in order to get around that? Because we're already all financially tracked in every way, manner, shape, or form. I mean, this is already happening. Digital dollars already exist. The stable coins, all they're doing is removing the euro dollar, the shadow banking leverage pump and leverage system to watch all those dollars flow outside of the purview of the U.S. monetary authorities, who can't control that issuance and therefore have no control over their own monetary policy. If you really want to make the argument about sovereignty and who doesn't have sovereign control over their own monetary policy, it's been the United States since Bretton Woods. And it was a system that was put in place by the British for the exact purpose of subverting U.S. sovereignty through monetary policy. So this is what's happening, and I just find it really rich that everybody's like, the minute the United States actually starts to act like a sovereign nation for the first time in my lifetime, everybody's bitching about it. Like, I'm sorry, but we're going to do this now. Like, okay. And if you don't like it, then issue your own stable coins that don't suck. Is really what it comes down. That's my as a dirty American. That's my view on. Because I see.
Tom, I've got to say, I would love it if you were right. I don't want to be right here. I would love you to be right.
Miles,
but it's,
I don't want you to be right either.
By the
US
I'm telling you, I know that's what the plan is.
Rightful place at the tier of the economic pyramid. I'd love that.
I don't. I think that's actually I think it's actually a squashing of the economic pyramid. And what Trump, if you look carefully, Miles, at what Trump has been trying to do. Okay, when he cuts these trade deals, he's not cutting colonial trade deals. He's not saying we're not going to invest and make partnerships. Like the deal he cut with Australia was really, really telling, because it was, hey, let's cut a trade deal. We're going to put a lot of money into actual production of the commodities that you're going to produce under this trade deal, but we're going to put the plants in Australia. That has never been the case in the past. In the case, it's always been, no, you just give us the raw materials, we'll ship them overseas, and we'll do something else with them. That's been the European colonial model going back 400 or 500 years now. Now, you could argue as to why they did that, whether it was, it's a spectrum of behavior. Early on, Europe was the first to industrialize. Of course, it was the first ones to then, we have to bring everything back to Europe because that's where all the factories were. And it was impractical to build factories in India where there wasn't the infrastructure for it. But I'm describing the 18th century. I'm not describing the 21st century. The 21st century, clearly we can build factories in India. Clearly we can build, ore processing facilities in Australia or Congo or whatever. And so it's a fundamentally different thing. It's not the CFA franc reborn, which is, so that's the thing. I think that's the part that everybody, and I get everybody's worried about this. I really do. So
thank you, John. Miles?
Well, I think it's also interesting when you consider the volatility we were talking about before we came on air there as well, and what that actually does over time for stable coins and enhancing more participation within the crypto market as well. And I think that's very, very interesting. So, it gives you safe parking for when there is this sort of down movement that we've seen. It also ensures in the rallies that people are putting dry powder, to the side and so on. So, it's absolutely fascinating. I don't think we're a million miles apart. I think
No, we're not.
I
I think
think
it's
Tom
just
just sees it as a more benevolent act than I do.
well, actually, it's not even benevolent. I'm not actually making the argument for benevolence. Actually,
Yeah,
to be honest,
fair.
all I'm doing, I'm not. What I'm saying is the following: this is what has to happen because the world is breaking up into currency blocks. It's moving in. We are moving into a re-regionalization of the global financial system. The Chinese are too financially powerful and too economically powerful for any one country, for the United States to lord it over them, or for London to lord it over everybody else. When you factor now, when you move away from just crypto per se, and you start asking yourself, what's going to be the pristine collateral undergirding all of these stable coins? This is where it gets very interesting to me. And this is a story that me and my friend Vince Lanci have been trying to work out as we've watched these moves be made over the last 3 to 4 years. And what we